Good afternoon, everybody. Welcome to our Long Options webcast. I'm Connie Hill. I'm happy you joined me here today. We're going to talk about a strategy. We know we're going to talk long options, but we're going to talk about a strategy that could potentially lead to some substantial gains. Could also lead to not substantial gains, just like any other strategy. But we're going to explore that a little bit today. I am joined in the chat by James Boyd. James is going to help me answer pertinent questions, things that are relevant to our discussion. As those questions come up, go ahead, chat those in. I try to keep a good eye on the chat so I can answer them, but James will also be there to help me out of any additional questions you might have. I hope you're following both of us on X. James is a prolific poster, right? He's James Boyd CS. I'm Connie Hill CS, and we'll post educational content, things that we notice in the market, observations that we think you might find helpful. We'll go ahead and post about those, or sometimes, quiz you a little bit. So go ahead, follow us. It's free to do so. Let's go through our disclosures, and then we will get down to business. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and educational purposes only. Don't consider it a recommendation. We will be using the downloaded software application of Paper Money, or of Thinkorswim Paper Money, I should say. It's the most robust version. It's helpful for option traders, which is good for our class here. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. All right, I'm going to talk it up again just briefly here. 3 events we have coming up. Next week in Chicago for a market drive event. It's a one-day event. It's on a Saturday, and you will love it. Okay, I'm just going to tell you that you will love it. Doing this similar type event in September in Anaheim, and then we'll be back to doing an option strategies and technical analysis workshop in September down in Miami. So if you're close to any of those events, get on over there. You will thank me later. All right. Our agenda is typically that we're going to talk about some concepts of long options. Now, most of you are exposed to long options. Many times it's one of the first strategies that you learn as an option trader because it's similar to buying a stock. We're looking for the stock to go up and so forth. So you might be familiar with it. This is in an intermediate level class, so we're going to kind of notch things up here a little bit. But we will talk about price, time, and volatility, those Greeks that are going to impact the price of an option. We're going to look at several examples here today. Now, I'm going to just ask you a quick question, and I'm going to use the answer to the question in a little bit here. My question to you is this. If you were to set up a trade, a long option, a long call, or a long put, and say it were for an earnings announcement type scenario, what percentage gain might you be content with to just put in at the same time you put in your order to buy the option? What percentage gain would you feel comfortable with putting in that you'd be happy with? Is it 15%? Is it 90%? Is it somewhere in between? Go ahead, throw those ideas out. I'm going to use that in our example trades that we're going to get to here in a little bit. Let's jump on over to Thinkorswim. You guys know what's been going on in the markets, right? Had a little bit of volatility, a little bit of pulling back Friday and Monday, of course, and then had a little bit of a recovery the last couple of days, last 3 days or so. I have implied volatility on the chart here. Sometimes I don't have it up, but I do happen to have it this morning or this afternoon. And we can see this rise in implied volatility on the SPX, right? Man, that is shooting straight up. It's not like a gradual move. It is way up there. And then we're having a little bit of it pulling back. As far as, well, the volatility ramped up, I should say, and the volatility is pulling back here a little bit while the markets go up, right? They have that opposite, typically that opposite reaction. Markets go up, volatility goes down, or volatility goes down, or volatility goes up, and the markets go down. So we've seen what's going on there. Let's look at the VIX here real quick. I want to see where it's sitting right now. So we're kind of back to areas, not kind of where our highs were almost this whole last year. We didn't get much into the 20s, so we're kind of settling back down into the 20s. And if I were to, let me do something here. If I were to just kind of, no, I didn't do that as well as I wanted to. Let's go back to a year. I want you to just kind of see in a year, kind of where we had been prior to that big spike. Okay, I'll include Friday here. All right, but yeah, kind of the highs were getting up there, maybe 22 or so. But we really hadn't seen anything shoot to the 30s for a while, like we did on around there Friday, and then of course Monday. Okay, for a long options trader, that could have been kind of exciting in the sense that, wow, we typically like to look for big moves, and we certainly got some big moves in the market that some of you may have capitalized on. Now I'm going to come over here, and I'm just going to eye what you're saying here in answer to my question about what kind of if we were to put in a return percent, what you might be comfortable with. Let's see, we've got a 10%. Sim says any profit is good enough if it's worth the risk taken. You're getting all philosophical on me there. We've got a 50, 50. The larger the number, the better, obviously, but we're going to plug something in here, okay? 20, 20, 20, 50, 30, 50, 50, 50, 35, 60. All right. You guys, I appreciate what you're comfortable with. We're going to incorporate that here in a little bit. Let's follow up on a couple of our trades from last week. All right. We were having earnings. We said, hey, we don't know which way the stock's going to move, if it's going to move up or down. And so we bought both a long call and a long put with the expectation of a big move, right? We call that a straddle. When it's right at the money. We went back, we looked at, how often our examples were Amazon and Apple, how much they move over earnings, and they're pretty decent movers. If you've got a stock that you're interested in maybe trading over earnings, or maybe it's just in your portfolio, and it doesn't move a whole lot at earnings, then the strategies we're going to talk about, last week's straddle and this week's strangle, might not be that exciting for it, might not be the best strategy, right? But those that make some big moves certainly could. Now I'm going to go back to something here on our slides, which was just the idea that when we have long options, we need the stock to move. We need to do it in a certain period of time fairly quickly. It will have time decay. Anytime you buy an option, right, you've got that time decay. And then we have what we call positive vega, which means if the volatility ramps up, then that will increase the price of the option. If we're holding it, that can be beneficial to us, right? And so we're always kind of trying to balance the time, price, and volatility. So as we look at one of our trades from last week, what I want to do is kind of talk about what happened here. So here's our Amazon. And I didn't mark our date on it. We got in here last week on August 1st, right before the markets closed, because that's when we have our class, right? The market maker move on Amazon was 12.15. So basically $12 movement was expected. Did it move $12? Well, it moved $12 and then some. Right? It had a pretty significant drop. So closed here about 184. Next day opens up down here, about 166. That's a pretty sizable drop. And it continued to go down for a while during the day and kind of came up off its lows and started to rally up a little bit. Now, the trades that we were tracking here, we did two of them. We did options that expired on August 2nd, so the very next day, so we didn't have a lot of time for the stock to move. And we also bought the August 9 expiration, knowing that, maybe if we needed a little bit more time, we could have that extra week in, being able to react to the earnings. So let me show you what happened. I'm going to put up a couple of things here. I'm going to put up account statement. We're going to go to Amazon. We're going to go to trade orders. And I'm also going to pull up a little spreadsheet that I started working on here for us. And I want to try to get both of them on the screen at the same time. And in the interest of time, I went ahead and I plugged in some numbers that we can pull off here from the account statement area. Okay. With that, I plugged some things in. All right. So we had our August 2nd expiration, August 9 expiration. We bought this call and the put above 182.50. And I put in here what each of those cost. Okay. So it was a little expensive, right? So for our straddle, 1330 for expiring August 2nd, the week further out, it's going to cost a little bit more money. There's going to be more time that we're buying there. So it was a little bit more expensive. Now I'll tell you what we did. And you can kind of see it in here. So here is our straddle here, 1380 and 1540, like I have in the spreadsheet here. The next day, when we got that really big drop and the stock pulled back, it was like, hey, this is looking pretty good. And so what did we do? This is kind of embedded in here. But basically, I said, let's go get what we can for the option, for the call up, for the call calendar, right? For the call, or for the call. Let me say that again. We had the big drop. We knew the put was the one that was going to be benefiting from that move, and the call, just not a whole lot, right? And so what we did, we went out and we just said, well, let's sell what we can get out of it, which was all of 2 cents. And if it's more than your commissions, then sometimes it's worth it. But it would quickly go to zero because it totally went the opposite way that we would want a call to go. So pretty much that's just money down the drain, right? We're not going to have much of a benefit. So we got all of 2 cents out of it. But then, so that was about 740. And then we kind of saw what the stock was doing here. So, and I should say the market opens here at 7:30, not 9:30. So, okay, this is my mountain time zone that it's showing us the record on. And then a little bit after 8, so the market had been open maybe a half hour. That's when the stock started to rally back up a little bit. And instead of being down here as a big red candle, started getting some shadow coming up here. And by the end of the day, we have what's kind of a look like a hammer. It's hammer-like looking. It has a little bit of shadow on the top, but definitely has the long handle, has the little head, and it can be a reversal candle, especially when it's at support or resistance. And that's right where it was. Okay. So the decision was made. All right. On those options, let's just go ahead and get out. Okay. And that's what we did. So as we come back over here and I grab my spreadsheet again, we got out of the August option. So we weren't in the trade that long. And we had this was our straddle cost. This is our 2 cents plus our 1985. That's what we got for selling the put. And so it was a pretty decent gain, 657, 49% for an overnight move. Okay, so not too shabby. That would kind of fall in line with what some of you were thinking, that maybe a 50% gain might be helpful. Let me just look real quickly, make sure there's see if there's any questions I need to answer. Thea saying, what is this number? I'm not sure, Thea, what number you're asking about. We talk about a lot of numbers in here. Oh, the number. Okay. Yeah, she's trying to figure out, hey, what was that? What is everybody guessing a number in there? What are they putting? Thea, it was what kind of a reward percentage-wise would you feel comfortable putting in, knowing that with long calls and long puts, we have theoretically unlimited gain potential, right? If it goes to extreme measures, yeah, those can add up. So I said, if we're putting in an order, we're going to do it at the same time we buy the option. What order to close it out would you feel comfortable at? Okay, so that's what people were letting me know because we're going to use that number. So, okay, Thea, you're the most aggressive, then you're 100%. All right, very good. Dragon Rider says 24 down. I think that means, you're telling me of the drop. Yeah, John says, well, who could predict this big drop? The market maker move, like I said, and I put it, did I put it in here? I didn't, on my other one I will. I told you the market maker move on this was $12 and some cents, which is a decent size move on a $180 stock, right? $182. Yeah, it's a decent size move and it went way beyond that. So knowing that it went beyond, I said 182, and that was the wrong number. 182.50, sorry, 182.50. I'll say it exactly. And it dropped down here. We're up, 182.50 is like right there. Whoa, it's clear down there. So this is a situation where you're like, I need to capitalize on it. Don't dilly-dally too long, which we did. But we did have the August 9 options, okay, that we could have played on for a longer period of time. However, let's look at our spreadsheet. What day did I say on here? And we can go to our monitor. Let me do that first, and then we get our spreadsheet. So we had our August 9s here. Same thing, straddle strangle, but a week out. They weren't quite, had as much implied volatility priced in them, although it was a lot. Okay, cost us a little bit more. Because we saw the candles starting to form that was looking like a hammer and a potential reversal, we decided to go ahead and just get out. We didn't make as much as we did on the expiration for August 2, but we still came out with a 26% for pretty close to about the same amount of time. Okay, so this one was a lot more aggressive because we only had one day to let the stock react. And I told you at the end of our session, I said, at the end of the day, I am hoping one of these moves really big and one of them is a dud, because I want to show you what happens when one of them is a dud. Okay. However, if we had not sold it on Friday and we wanted to carry it into the next week, that's possible, right? We bought enough time for that. I wanted to do a what if, and so I used Think Back to help me out. I hope you guys know what Think Back is. And so what I want to do is I want to say, well, let's suppose on our August 9s, we didn't sell out on this day, although we did. And we got this big bump here. We got another big drop. And let's suppose the worst case scenario, which is less, well, it's not totally the worst case, but let's suppose it dropped. We didn't capitalize when it was down here, but we did at the close of the day after we saw kind of a bullish looking candle, right? It had been down lower and then the bulls pushed it back up by the day's end. If we had done that, which we didn't, what would the numbers look like? Okay, and they're a little bit better, not tremendously. Okay, so here our call would have been worth a whole 8 cents. That's what we could have salvaged off of it, which was not a lot. This call we only got 2 cents off of, but the put, if we had closed out at the very end of the day, would have been 21.20. And I hope you guys know how to use this tool, and maybe you're starting to get a little bit comfortable with it. It's called Think Back. And this shows us what the price of options are at the end of a day. Now, they have lots of prices throughout the day, right? So it records the closing price. So that's why I said, let's just suppose we held on to it till maybe the close of the day. Would it have been that much better for us? And so we can take our calendar up here and say, okay, instead of us getting out on August 2nd like we did, let's suppose we held it on Monday. We had that big drop. Who in the world knew that Japan was going to unwind some trades and foul the whole trading universe up, right? We didn't know that that was going to happen. Just happened to. And so, yeah, we could have got out a little bit more favorable price. I just took the bid price. I didn't try to do the midpoint price, although in reality, maybe we could have done something in between there, but 21.20. So it would have been a more significant gain had we decided to do that. Okay. So if you want to go back and say, well, what if I had made this decision instead? What if I had made that decision instead? Know that you can use this Think Back as a nice little tool to say, okay, what were the price of the options at that time? Okay. The other trade we did was Apple. They both announced after the market closed. Yeah, we were under pressure Monday. That's for sure. Yeah, we couldn't predict that big drop. Let's zoom in here. And we've got a similar situation. Let's zoom in a little bit more. I want you to pay attention to the implied volatility dropping here as well. So we got in Thursday afternoon in our class. What happened the next day? Big dud. This Apple stock did not really move all that much. It didn't. It got down a little bit lower than where it closed, but it didn't stay there. Okay, it just stayed for most of the day in this pretty tight range. It was a total dud. And you can see implied volatility. What did it do on this day? On this day, we're seeing a little bit of implied volatility drop, but Friday turned out to be a little bit of a volatile day as well. And then on Monday, man, that implied volatility popped up. So that would have increased the Vega exposure on the option, right? If volatility goes up, that would increase the price of that option, make it nicer. So what happened here? Well, this did exactly what I hoped one of those trades would do, that it did nothing. Okay, and so our trade that we made that was August 2nd really we didn't get that much out of it. And then I have to be truthful with you and tell you I forgot to monitor it. Okay, we got out of our Amazon trade and I was monitoring it. There was so much going on, I kind of forgot about our trade. So it's actually still sitting there. Okay, and I'll show you. And you can't do that with trades. If you're doing these kind of trades, you really need to pay attention. I didn't. So this is what we have here. Okay, so we still have our August 9s. Is either one of these profitable? Well, the call is not all that profitable, but we could salvage a little bit of it, or we could say, well, let's see if it gets a little more of a run tomorrow, but really we need to be out. Time decay is like shrinking it, right? Because we're seeing here, it's only worth 24 cents. It was initially when we bought it, we paid $6.10 for it. Now the put is looking a little bit better. However, this is interesting. Had we taken action earlier in the day, we would have had a pretty decent look on our put. But quite honestly, I did not monitor it. Okay, this is what can happen if you fall asleep at the wheel. So don't fall asleep at the wheel. We're all over on top of Amazon, had the dud on Apple. I was glad that happened, then I kind of forgot about it. All right, so that's what happened with those two trades. So numbers wise, not too bad. Right, as far as our Amazon trade, hitting the one that we closed out of initially, close to that percent that a lot of you said, maybe about 50% you'd be okay with. We are going to look at some other trades today, or some other stocks, but we're going to do a long call and a long put, but we are going to do strangles. What's a strangle? Well, a straddle is the very same strike price, right? We had our 182.50. A strangle is a little bit out of the money on the put, a little bit out of the money on the call. And the more out of the money you go, the cheaper the spread is, but the more the stock has to move. Okay. So I've got 3 examples. I don't know if we'll have time to get through all 3 of these examples. Before I do our first one, I need to remind you, how many of you still have not subscribed to our Trader Talks channel on YouTube? If you haven't, now's your time. Go ahead, click on that little YouTube looking icon that's blue in your bottom right-hand corner of the screen, and it will make your life easier for you. Okay. Well, let me click on the right one. You are selecting that. Ooh, something went weird on me there. Let me try this window. There we go. There's our Trader Talks on YouTube. Okay, there it is. You'll be able to see what's coming up in the future, and you'll be able to see what James just taught shortly. This was actually yesterday. Certain industry groups at further risk. That sounds intriguing. We'll post some of the most recent webcasts that have just posted the website. So here's our long options. We're in it now. Coming up when we're done, we'll do gettoknowschwab.com. Brent Moore is going to lead that discussion. And so you can kind of see what we have coming up. You can say, notify me, let me know about it. If you're somebody that's like, I don't want to ever miss Connie's class or James' class, you can set little notifications, okay? It also moves us up in the algorithm so that others find our content easier as well. From this, just kind of generically, if you wanted, you could just go right to the playlist. If you're a webcast that you're following all the time, or you want to binge watch, that is a great way to do it by clicking on the playlist. Okay, so do yourself a favor, subscribe if you haven't done that. I know people are joining us all the time, and so it's always good to let them know how they can join in the fun of everything. All right, let's go look at another example here. Now, I have three. I don't know that we'll get through all three. We're going to do strangles on them. These are stocks that typically make big moves at earnings. Okay, the first one we're going to talk about is TTD, the Trade Desk. Okay, you want to go back. You want to see how they react over earnings. If they do not jump or drop big, straddle strangle, it's not probably going to be the best strategy for it. Okay. So we can see, yeah, it's done some moving here recently. On the Trade Desk, they are going to announce tonight after the market closes. So we're going to be able to, go into after hours pricing, and we can see how the market is reacting, at least to the initial numbers. Tomorrow morning, we'll kind of get another look at it, see if it moves around in the pre-market. And for any order that we put in, we might choose to adjust it because of what we're seeing. Okay, adjust it beyond what our initial order is here right now. So the Trade Desk is one that's moved. How much has it moved? Oh, we need our market maker move on here. Where did he go? Apparently it fell off, so I'm going to put it back on. I probably put on a style that didn't have it. And the market maker move, remember, prices in essentially what the market maker has, what the premium is that they have essentially put into the option for what they think the stock could do, how much movement it could have, up or down. They don't say what direction, they just say up or down. And what's nice with this little script, I will share it with you in my notes, okay? Notes that I put into the YouTube video for those of you that don't have it. So we can kind of see, just looking at it, well, what's the expected move? If I go to the trade tab, and we can leave that up, that's fine. The market maker move right now is $9.29, either up or down. Look how much implied volatility is priced into these front week options right here. 110%, whereas kind of you get back down to normal, it's like 47, 54. There's a ton in there. That means these are really, really expensive. Some people might think, well, that maybe would use a selling strategy there. That very well could be the case, but that's not our class. Our class is long options. So we do long options in our class. So for our purposes, what we're going to do the August 16 expiration. We're going to go out to next week. They're still pretty pricey, but not quite as much implied volatility priced in it. Remember, when the news comes out, usually the implied volatility comes crushing out of that option, which means the part due to implied volatility, that shrinks, right? That part goes down. And that's why we really need there to be a big move in the stock, because we've got to overcome what we paid for that spread, whether it's a straddle or in this case, a strangle. Now, earlier when I was looking at things, I was coming up with about 88 as our at the money strike price. And so given that it was about, and now it's about 80, we're still going to go with 88. That's still closest to 88. We're going to go a buck out of the money. Could we go more? Sure, we could go more. It makes it a little bit less expensive of an option if it goes more, right? If you go more out of the money. However, the stock probably, has a different strike price it's got to get to, all right? So we want to be aware of that. So what I lined up here, I started out, let's do, okay, we've got the 80, this is 87, or 88, let's do 87 here. And so let me change that. I had it at 86 because at the time where it was registering. So we're going to do an 87 and 89. Oh, look at how nice that is. This is just smack in the middle for us. Yeah, about $5 for each option. Okay. So for the strangle, it's going to cost us about $10. Now we're going to throw this a couple of figures in here. Number one figure I want to throw in here is our market maker move, $9.18. Okay, let me unhide this. And let me do it better. Let me unhide it better, I guess. I think I hid that accidentally. Okay, so here's our second group of numbers we're going to work with. So here's our trade desk. Okay, the market maker move, it's changed a little bit. Right now it's down. Well, it's down to about a little bit lower. We'll put 8.99. Actually, I'm just going to put it at 9. Okay, it's about 9. So we're expecting that big of a move. And let me just format this the same. All right, that's it. That's what the expectation is, either up or down. We don't know, right? Right? We don't really know how the market's going to react because we don't know what's going to be said. We don't know what their forecast is going to be. They might give further guidance saying, oh, things are looking lousy, guys, right? We did good this quarter, but next quarter and the next, not so good, right? We just really don't know. So given that that's the case, so we've got $9 there. And this one now we're going to do, what did I change that to? 87, we're going to do 87 and 89. So I guess that's right there. Okay. And let's put in what it's going to cost us for each one. So earlier it was about $5. And now, the 87 is 5. So let's just put it up 5. And the 88 call, ooh, it's changing on us, is now $5.50. Things change quickly. Okay, so it's going to cost us about $10.50 for this trade. Now, I added a column in here that we didn't really use before, but I think it's a helpful column to have. And again, I haven't even saved the spreadsheet. It's not like it's a fancy dancy spreadsheet, okay? But it's helpful if you kind of lay it out as you're planning your trade. So you want to calculate, well, what's our break-even point? We can use the theoretical pricing model, right? We can go to analyze risk profile and we can see. Some of you are better with, just kind of the number there. You don't necessarily need to see a picture. So really the break-even on the put side is going to be our, and you can see my little formula there, is whatever the strike price is minus the premium. On the call side, it's whatever the strike price is plus the premium. Okay, so we have two break-even points quite a ways away from each other. And if we do look at this in the risk profile, which we're going to do for just a moment, so let's say analyze trade and come over to the risk profile. And let's get rid of that single. So we should have this should be 88. This is kind of left over from what I had. So 87, 88, we'll just move this out of the way so he's not a bother or a nuisance, okay? And we've got that's not right, 88, 87, I'm off a strike price. I think this one, was this supposed to be 89? Now I have to go back and look real quick. It's a good thing I wrote that down on our spreadsheet. Okay, 87, 89, because 88 is right at the money. Okay, 87, 89. So we're going to change this guy. And then I'm going to unlock that. So it's floating around, it's around $10, right? A little bit less than. Now, let's come over to the risk profile. Kind of shows us graphically some things. We're going to say set the slices to the break-even point. We're going to choose the Saturday after the options expiration. All right, and then what it's going to show us is where our break-even points, which are right where it crosses here, right where it crosses the zero line, right? Because over here on this side is the profits and losses. So the numbers above zero, profits, the numbers below zero, losses. And this one thing gets people really excited, which is, oh, unlimited potential, right? I say, man, the greed monster in you can come right out when you see unlimited potential of the trade. But remember, we only have a specific period of time for which we need the stock to make that kind of a move for us before the option expires. And in this case, what we're trying to do is capture that big move and hope that it's really big one direction or the other, or say our put's worthless and our call makes money, or our call is worthless or just we sell for peanuts and our put makes money, and we need that big move to make sure that we get beyond the strike prices. So about $10 beyond them. Let me look at the chat here real quick and see what we need to do. Now, Chris says, now if the price doesn't move much, we lose both options. Yes, you absolutely do. That's why I was kind of excited about our Apple trade that just didn't go anywhere on Friday last week, just like sat there. And yeah, so it just completely lost money because it didn't move. And that could happen here too. Trade desk, it just kind of sits there. For our purposes, we're going to go out an extra week though, because we might need a little bit of a buffer there, a little bit more time for the stock to maybe make a kind of move that we need. Okay. Yeah, we talked about this last week. Don't wait until the day before earnings because implied volatility really creeps up. That's why we're seeing these really expensive premiums. So if you're thinking about something, you might buy it a little bit in advance. Okay. All right. I think I'm up to date. If I'm not up to date, let James know. All right. So let's do this. I want to put both these trades on, and I want to use a percent that you felt comfortable with. As a group, the most popular percent that came back was about 50%. Okay, so this is what we're going to do. Going back to the trade tape tab, we are going to do both of these, okay? But I'm going to delete one of these here. Let's do our put first, and we're going to put boundaries, exits for making money, exit for losing money. Okay, so we're going to do a first triggers OCO. See how I want to do this. Let's create two opposite orders here. Create opposite order. This first one, we're going to put in a 50% gain. So a 50% gain on a $5.15 is, multiply that by 1.5, it's going to be $7.73. We're going to put it in there. And then you want to choose a value of which you say, you know, if it gets this bad, we probably just should get out of the trade. If I lose 40%, 50%, whatever your number happens to be, right? That's the number we're going to put in. For this one, because I'm going to expect some big movement here, we'll put in 50%. It would be nice if we could salvage that, but if we get a really big move, we probably are not going to be able to salvage 50% of both options. One's probably going to do great and the other one won't, right? And so if we go here about, say, 50%, that's going to be about $2 and let's go 55 cents. Okay, this is going to be our stop. Both of these are going to be good till canceled. Okay, so this is the put side right now. We're going to send it on, and I'm going to put it in our long options grouping, and we should get filled on this. Now let's go ahead and do the call. On the call, we're doing 89, right? We're going a little bit out of the money. The 88's kind of our at the money strike price, so we'll go 89. We're going to buy it. We're going to do a first triggers OCO, create two opposite orders. And I actually could have done that from the top, but I didn't. Create another opposite order. Okay, a 50% gain on a $4.85 option. Going to take 485, multiply it by 1.5. That's going to give us 728. And then half of this is going to be what? It's going to be about 240, right? And that is going to be our stop. We're going to make it good till canceled. Till canceled. And no, on this stop, it'll trigger a market order. Market order doesn't guarantee a price. We're just saying, hey, get us out at the next available price, regardless of what it is. All right. Sometimes we can get a good fill. Sometimes we don't get a good fill, especially if it's first thing in the morning. But we say we want to be out. Execute that for me. Okay. Now, last week, we did not put in values. right? Last week we said, oh, I'm going to watch it the next day and see. Today we're going to put in a percent that we're happy with. Now let's do one more example here. Frankie says, let's see. Just checking your comments here and see if there's anything that I need to address. But I think we're in good shape. Okay, you guys are just chiming in. Okay, next one up. We've got two to choose from. Okay, the one I was thinking of doing was Expedia. Okay, Expedia, just from what we have on the screen, big moves, right? It's not a dinky mover, typically is a bigger mover. So the strategy, okay, we're interested in it. Let's go to the trade tab. 117, we're going to again use the August 16 options and open the interest and volume. I didn't really point out on the first one, but there was decent enough. This one has even more open interest. So if our strike price is about 117, we're going to go, we could go 116. We could go out a little further. We could go 115. Right? We could spread it a little bit more. It's a little bit more less expensive, but then the stock has to make kind of a bigger move, right? So let's just do $2. Okay, so we're going to go 115 on the put. And let's say by custom, we'll do the LCL bracket for here. I'll be efficient this time. All right, and we're going to go still with that 50%. If it gains 50% overnight, you are going to be a happy camper. So 1.5 times 5.3 is $7.95. And half, say 50% of the price of the option there. If we divide that in half, we're going to come back with $2.65. Okay, so we're going to put $2.65 on the price of the option as our stop. Same thing, it'll trigger a market order there. Make both of these good till canceled. We're expecting to get filled on this right now. I'm just going to leave the price locked. I'm hoping that it's similar. Okay, it should fill us at a little bit better since it's 10 cents less right now. We should get filled about 5.20. All right, we're going to go ahead. I'm just checking to make sure I haven't forgotten anything because we are doing it a little bit quick. But the idea here is if it makes a really big move, we'll be interested. Now, I was going to go into the spreadsheet, but it's essentially very similar. All right, I was going to put information in here and I didn't. Okay, I was going to put the premium and let it calculate the break even. We'll let the system calculate the break even for us. If you want to see that, go to the risk profile if you're trading this along with me in your paper account. What I wanted to go through was, how do we monitor this? What are we doing? Okay, Expedia is going to announce tonight after the market closes as well. So we're going to want to watch it, right? We're going to want to see what they did when they announced their earnings. So what we might do here is make sure on your charts, come over here to equities, make sure you have this box checked, show extended hours trading session. And then I have it highlight it so it goes gray, so you can just easily distinguish when was the after hours and pre-hours time frame. And then just look at a one day chart or 1 day 1 minute chart, and we should be able to see, hey, we'll see where it finishes today, and then we'll be able to see after they announce earnings what direction that might be going. Now, if this totally blows by the market maker move, which right now on the top side is about 129, what if it were to pop up to 135? If it were to pop up to 135, no implied volatility is going to come crushing out, but it might be gaining a little bit more extrinsic value. And if you wanted to, you could go into your order and you could come up here on your working orders and change it, right? You could come here and here's our stop loss here, but here's our target. We were on Expedia, right? And you might go in and you could do a cancel replace. You could say, I want more than 50% now because I really think this thing is going to hop, right? You could come out here and raise that to something else if you want. You can use the field price calculator. to give you an estimate of what might happen. And of course, wherever it is in pre-market hours, it's not guaranteed to be there. Like it might, after hours today, might get to a spot, but it's not guaranteed to necessarily open there. And so that's why it's helpful on your charts to bring this up so you can be monitoring. And then if you do want to be happy with your 50%, great. If you're not, and you want to be greedy, and I'd say that nicely, right? You want more out of it because it looks like it can give you more, then you might go out and change over that order that you have in your working orders and to accommodate for that. All right. Chris says we need to shelve it and move on. What are we shelving? Oh, if it were going to be a revenge trade for you. Yeah, sometimes we don't want to let our emotions get involved too much, do we? All right. We're going to watch both of these options for price, time, and volatility. Volatility should come crushing out. We don't have a lot of time, so we're not going to have a ton of time decay, but we've only got a week on them, right? So we're expecting if you get to a move that you're happy with, there's nothing wrong with just saying, great, I'm happy with that. This is a short-term trade. It's going to expire next Friday. Let me take what I can get, okay? So I'll be interested to know what your thoughts are. If any of you do this as a practice trade in your paper money account and you want to share how it ended up for you or what you decided, feel free to let me know on X and I'll respond to you, okay, on that. All right, well, we are out of time, guys. Appreciate you being here. I appreciate James being in the chat answering questions. I did not see a survey, but if you found this helpful today, then hit the smash the like button on your way out. Now, coming up next is going to be Brent Moores to learn more about Schwab.com. I will be there in the chat, so I'm going to see you there. Take a 15-minute break, and we'll be right back with you. We'll see you then. We'll follow up on our trades. Bye-bye.